Hello everyone. The following video was put together a few years ago now. The graphics are a bit vintage, but the content is relatively timeless. I hope you'll find value in it, and thanks for watching. In this presentation, we define self-employment as per the IRS website. We will look at a few details of the self-employment tax per the IRS website. We will look at 3 scenarios to help you understand how the numbers flow through the system. But before we get started, we need to review the disclaimer. The information contained in this presentation is provided for a general education and overview of the process and system. Is as is, with no guarantee, warranty of timeliness, or any other kind, express or implied. Is not intended to be legal, accounting, tax, management, or other professional advice. Due to the nature of this presentation and the ever-changing information, software, hardware, rules, and laws, you should verify the most current information and always consult with a qualified professional advisor who understands your particular and factual situation before making any decisions. The receipt of this presentation does not constitute an accountant-client relationship, and changes may be made to this presentation from time to time without notice to the current user. Now, let's get started. According to the IRS website, generally, keyword, you are self-employed if any of the following apply to you. You carry on a trade or business as a sole proprietor or an independent contractor. You are a member of a partnership that carries on a trade or business. You are otherwise in business for yourself, including a part-time business. Please note the key words, trade or business. Now, we highlight some key points about the self-employment tax obligations before we get into the 3 scenarios. Self-employed individuals generally must pay self-employment tax as well as income tax. Please note, these are 2 separate taxes. That self-employment or SE tax is a Social Security and Medicare tax primarily for individuals who work for themselves. It is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners or W-2 wages. Before you can determine if you're subject to self-employment tax and income tax, you must figure your net profit or net loss from your business. You do this by subtracting out business expenses from your business income. If there is a net profit, it becomes part of your income on page 1 of the 1040. If your expenses are more than your income, the difference is a net loss. Usually, key word, you can deduct your loss from gross income, but in some situations, your loss is limited. And generally, you are required to file an annual return and pay estimated tax quarterly. With an understanding of these basic points, let's look at 3 scenarios to help understand how the self-employment tax and having a small business affects the bottom line. We will do this through a simplified and summarized 1040 format, where we start with income, subtract adjustments to reach the AGI or adjusted gross income. From there, we subtract out the standard or itemized deductions. In all 3 scenarios, we use the standard deduction of $11,600. We then subtract out the exemptions. In all 3 scenarios, we use the same amount of $7,400. From there, we arrive at taxable income. From that, we calculate the income tax. Then, the other taxes, in these cases, the self-employment tax. We adjust for the payments and withholding to arrive at the net refund or amount due. Included in these scenarios, we have a state tax of 4.3%, although not all states have an income tax. Finally, we arrive at the total refund or net due amount. In scenario 1, we have a husband and wife unit filing jointly using the standard deduction. One spouse has W-2 wages of $85,000. With no adjustments, less the deductions and exemptions, the taxable income has arrived at $66,000. With the federal tax, over $9,000. There was withholding of $10,000 for a bottom line refund of $946. Now in scenario 2, the other spouse decided to start a small sideline business. In the first year, the business had $30,000 of revenue, with deductions for costs of goods sold at $5,000 and expenses of $5,000, to arrive at a net taxable income of $20,000. This net amount is then included on the 1040 under income. This income creates an adjustment for the deductible portion of the self-employment tax. In this case, it's $1,413. This, with the $85,000 in W-2 wages, totals the AGI to $103,587. Less the deductions and exemptions, taxable income arrives at over $84,000, with the federal tax calculated at $13,394, with the self-employment tax calculated at $2,457. The withholding is the same at $10,000, and the state tax has increased by 4.3% for a total tax due of $6,815. That's an increase of close to $8,000 in tax from the extra $20,000 from the small business, which equates to 39% of the net income going to taxes. In this situation, the new business owner did not make estimated payments throughout the year, creating penalties and interest. The first point here is, don't spend your net income until your taxes are paid. The second point here is to add up the tax percentages. Based on the current tax brackets, in this situation, the federal, self-employment tax, and the state tax add up to over 42%. The difference between the 42 and the 39% is due to the graduated tax brackets. Now, let's look at scenario 3. In this scenario, the client had a better record-keeping system. In both scenarios 2 and 3, the client drove the same amount of miles for the business, meeting customers and picking up supplies. But in scenario 3, the client spent a little time and tracked the mileage, of which added up and calculated to $4,500 of expense, based on the current mileage rate. The client also found several missed receipts totaling $1,500 in expenses. Please note, the same dollars were spent in both scenarios, but better record keeping led to the expense on the tax return. This extra $6,000 reduced taxable income to $14,000. Now, as the information is processed in the return, this extra $6,000 in missed expenses lowers the total amount due to $4,387, which is over a $2,400 tax savings. Now, what if that extra effort took an hour a month? That's over a $200 savings per hour of effort. Spread over 5 years, a savings of over $12,000, and over the course of 10 years, you would have saved almost $25,000. In summary, the phrase after-tax cost should have a clearer meaning. In scenario 2 and 3, any ordinary and necessary expenses that could be used for the development of the business could save in the range of 42% in taxes, making the net cost of the items purchased about 58% of the actual cost. Every situation is different, but the point here is to understand how the information, dollars, and taxes flow. Hopefully, it's clear that what you gross and what you net could be a very substantial difference. Understanding the importance of record keeping and the overall knowledge of the system could produce amazing prosperity over time.